There is work that's being done. Here's a forecast, if you like, of the percentage of non-hydro renewable energy that's scheduled to be generated between now and 2030 across different countries. So we have some of the transition economies which are starting from a relatively low base but are working up to still small percentages but big growth relative to what their current base is. We have OECD Europe, which is on a very aggressive path to 2030. The roadmap to 2050 is a key component of that. Obviously, Asia is a key component in that path as well. So this was one problem. On one side was a requirement to mobilize large-scale capital, and on the other side was to mobilize that capital directed into low-carbon infrastructure, technology, and services. We like big problems at SDCL, so we started to dive in a little bit. I think there was someone who talked about mapping, if you like, the process of mapping the environment that you're working in. So we took a look at globally some of the I guess convergence of factors that may drive an investment proposition for an institution, bless you, into environmental finance. So we have things like obviously a funding gap. Capital's not flowing into developing markets for low carbon infrastructure. It's flowing in at a pace, but not at a rapid enough pace to meet some of the targets we're working towards for low carbon. And that was a key item. There's certainly an awful lot of regulatory drivers that are taking effect, and it doesn't matter whether it's developed countries or developing countries. Governments are starting to get the picture that they have to provide a regulatory framework that includes both incentives, whether that be feed-in tariffs for renewable energy, or regulation, moving some of the utilities into having higher percentages of their energy production from renewable energy. In fact, some of those regulatory frameworks create markets which allow capital to come in, and it's an important feature. But it can't be done just on its own. There's growing demand. That's been a constant theme, I think, across the last 2 days, is that obviously population is growing, economies are developing, they're becoming richer, people are demanding and consuming more. So there's an issue around growing demand. And then obviously regional environmental concerns. And this was both global, from a Western government's perspective, in trying to do what it can do locally, but also getting involved internationally, because it can't solve the problem locally, not entirely. And then also regionally in these developing countries, which in most cases are the most impacted by climate change, especially African countries. So these factors, from an institutional investor's perspective, are things that we look to understand where investment opportunities can come from. And when you get a number of these factors moving in the same direction, it creates what we put forward as an investable opportunity set. So there are institutions who are actively looking at ways to try and mobilize capital. They have some interesting constraints. A lot of the private and public sector institutions, whether they be the large sovereign wealth funds, the large banks, the large pension funds, insurance funds, in most cases there's usually an institutional constraint that restricts them from making what's called a strategic investment. So a strategic investment is something that is, I'll back up 1 second. Most institutions are required to make financial investments. They have to invest as financial investors for the benefit of their beneficiaries. It restricts them from making strategic investments or policy-driven investments to a large degree. Now there's exceptions, and usually it's around the corners, around the edges, and you'll hear pension funds like TIAA-CREF in the US talk about its social housing program and that it's invested $500 million into social housing with the United States. Well, it's a niche, because TIAA-CREF manages about $430 billion. It's one of the larger public sector pension funds in the United States. And their challenge is they can't invest strategically. They can't make an allocation across their portfolio, whether it comes from their fixed income portfolio, from their equities portfolio, or their alternative investment portfolio, into things like climate finance, sustainability, and some of those things. It's a challenge for them. So the P8 group spends an awful lot of time with those pension funds. There's 12 of them, and they represent about $3 trillion of total assets. They're probably one of the larger groups of large asset owners. And they get together around this discussion point. They've been doing so for the last 3 years. And it's got a number of interesting dynamics. There's a couple of takeaways that I wanted to add in. You know, for the multilateral development banks, you guys actually covered off an awful lot of the key constraints and some of the opportunities. You also had the exact same bias that the multilateral development banks have, which is we want to do this, we want to manage the money, and just give, as the private sector, just give us the money and we will manage and deploy it in these emerging markets where we've been for the last 50 years. That's a common bias for most of the multilateral development banks and DFIs who we spoke with in the process. And it's a natural one. It's, you already have expertise, you got capabilities, you've got track record, albeit it's a track record that when you talk to the private sector institutional investors, they're not on board for. And that was one of the feedback that we got from meeting with the 12 pension fund members. And we asked the question, why aren't you allocating capital today to the multilateral development banks who've been active in these markets for 50 years, who are investing and providing equity and debt and guarantee programs for low carbon infrastructure in these developing markets? And it came down to returns. I think you'd referenced, I heard in your conversation, returns of sort of 3 to 5%. And, you know, if our pension funds over here have an actual rate of return requirement to meet their beneficiaries' requirements of 6 to 7 or 8%, that doesn't reconcile, especially when you take into account the risks associated with your 3 to 5% relative to where they can get 7 or 8% in developing economies. So that's a big constraint and a significant challenge. So we'll get to that, and we figured out a way to sort of solve some of the constraint. So the pension funds brought up a very good point. They said, make climate finance investable. Get us our 8% or 7% actual rate of return on a risk-adjusted basis. So we know emerging markets generally generate higher rates of returns because they're faster-growing economies. They typically have, you know, they're just faster-growing, more dynamic economies than a lot of the developed economies per se. So they usually compensate investors by entering into those markets, which have more risk attached to them, with higher rates of return. But it's not just a return equation, it's a risk-adjusted rate of return equation. So I'll get to why multilats fit to plug in and make the institutional investments more institutional, if you like. The asset managers, you guys covered off, you know, you guys are always available with expertise, capability, and track record, so we've got lots of asset managers who are putting forward their capability. What's interesting is we ask the same question of the pension funds, why they're not investing with the asset managers today. Why aren't they investing with JP Morgan Asset Management on its private equity fund-to-funds program? They manage $30 billion of capital into private equity and infrastructure. Same thing with Credit Suisse, same thing with Partners Group, a number of different groups. And it came down to, from a pension fund's perspective, concern over the lack of resource and capability in these developing markets. So if you actually talk to some of those institutions, they might have organizations specific to private equity funds and infrastructure that might have 150 people, professionals working in those groups, managing that 30 billion in capital. The difficulty is they might have 4 or 5 operating in Asia. They might have 1 or 2 operating in Africa, and they might have 3 or 4 operating in Latin America. So it's a capacity issue and concern. And the pension funds, again, they have a fiduciary obligation to make financial investments. So it's not quite investable. So again, multilats can play a role because they're in that marketplace. They've been there for 50 years. They have feet on the ground. They have people. They have resources, deal flow, technical assistance, all of the things that the asset managers don't necessarily have. Governments were interesting. Government discussion was very much around, we want to mobilize capital. We want to crowd in the private sector. You know, so we want to make sure we don't crowd out the private sector with our capital and our expertise. We also don't want to, what was a key point with governments? We also don't want to have to be the full source of capital. Governments, especially developed country governments right now, are very constrained. Everyone knows that here in the UK. We're in the midst of a bit of a recession. Government budgets are being cut. The government doesn't have a lot of capital to become that $100 billion. And governments around the world, especially the 25 that signed on the developing side, know that. So they need to figure out a mechanism that brings private sector in to the equation. So they said, we're happy to play a role. We're happy to play a facilitator, a seed capital provider, but we cannot be the full total capital provider. I'm going to just take 2 minutes to finish up and show you guys the end reveal or unveil, if you like. And then obviously we'd love any questions because there's been some great comments. So to your investment point, obviously sustainable development goes beyond just low carbon infrastructure. So sectors such as sustainable urban development, so zero carbon city developments is an investable opportunity within the set. Water treatment, waste treatment, sustainable land management, including agriculture and forestry is a key item. Energy is a big one because it's a large area and you can deploy a lot of capital at scale. And it also has a direct impact on low carbon. So it's part of the mix, but the others are equally important, whether it be adaptation or mitigation and focus. So the net of it is no single private actor in this room has the capability to get access to these pension funds' institutional capital on their own. And that was the biggest single constraint in the process, and is in the process. So it is really about making climate finance investable for private sector institutions. And yes, we can certainly change regulation over time and try and allow financial institutions to move away from being strict financial investors to incorporate some strategic investment, but that's going to take a long time. Pension fund reform typically takes anywhere from 15 to 25 years. It's a slow-moving ship, and it takes a long time because of the trust and the capital that's entrusted under that process and structure. So what can we do today? You know, we came out of Copenhagen, 100 million was committed. We've got to figure out how to mobilize that capital, and these are the actors in the room that we have to work with. So we looked, from our perspective, we asked each actor what the strengths were, and we've got an awful lot of the strengths out of this group today, which is great. There's some more as well that we pulled out. We looked at the challenges and constraints, and then we decided to figure out how to assemble a public-private partnership at all the levels that it needs to be at to effect an investable investment solution for the pension funds and the sovereign wealth funds. So you've got actors like the multilateral development banks or the public sector. You know, they can provide investment capital. They can provide risk mitigation tools, so policy risk support, technology, execution risk support, country risk, currency risk, you know, just sometimes insurance around being able to take your currency out of a country sometimes can be a key component to de-risk a proposition. Obviously, policy dialogue with host country governments, it's a key component as well. Access to sources of concessionary finance and targeted subsidy. So that's actually directly investing, but there's a way to go about facilitating that investment that's important. And obviously environmental, social, technical, and governance advice. So it's meeting some of the local development initiatives that are important at the end of the day. The private sector, very efficient. You know, that's private sector. It's about generating returns for stakeholders, which can include investors, employees, management, and the economy and the general community. But they bring investment capital. They have access to pipeline of commercial projects. Obviously, that's a key component. Commercial expertise, investment expertise comes back to making something investable. So those asset managers in the back, they've been managing money for 25, 30 years. Mostly they're managing institutional fund money already today. So they're trusted, they have processes, they have infrastructure, they have services, and they're capable to do so. They also have an ability to attract and mobilize additional capital. So they're usually in a case where they're bringing in outside capital in already. They've got a lot of those conversations, so it's a key component or actor to have involved. And they also have the ability to build capacity quickly. So if you can think of like a JP Morgan or a Credit Suisse, if they have initiative, they can put together 35, 40, 50 people very quickly onto a platform. What that comes out to is, this is a framework, and it's something that can be applied globally. It's something that can be applied nationally. It's something that can be applied even regionally. And we've got certain municipalities and states who've actually started to take a look at how to apply this, sometimes in the context of a technology transfer program, sometimes just in a direct low carbon. But the way we've approached it is because of the stakeholders we're dealing with, principally the P8 members who want to deploy capital at scale, is we've had to design an investment program that meets their requirements. So, and I apologize if it shouldn't be complex, but if you're not familiar with sort of this type of framework, I'll quickly run through it. So we have public sector institutions on the top left. These are typically your multilateral development banks and governments who have some pretty close links into what they're trying to achieve. And then you've got public and private LPs. And when I say public-private LPs, a public pension fund, we would qualify as almost a private institutional investor, but they obviously manage money for public sector employees, for instance. We do design, who was it that came up with the fund of funds? That was perfect, because you almost let the cat out of the bag right at the very beginning. And there's a reason why we've structured it this way, because there's different ways you can go. If the whole idea is to get to $100 billion of capital, you've got to figure out a way to leverage, and I'll show the leveraging impact and effects. You've got to figure out a way to leverage capital into the system. And the best way to do that is sort of build some structure into it that already uses current technology and financial engineering. It was one of the other key points I think I made to the back group and the asset managers is that none of this can be new. None of this can be innovative, none of it can be untested, none of it can be untried. It has to be proven and established, because that's what makes it investable. Anytime you start adding in newness or innovation or untested treatments, you tend to lose the investors on the other side, on the private sector side, because they'll take a I don't need to make the decision today. I'm still getting my 8%. I just won't take the risk. So everything that we pulled in has been a strength, but from an organization that's already in place. So that capability with multilateral development banks, whether it be technical assistance, it's pulled in. It's already there. It's not something that has to be developed. Governments, same thing. So the structure is basically a fund of funds, would be a fund of funds in this case. It doesn't have to be. You could expedite it and just skip right down to investing directly in private equity fund managers, but in this case, it's structured to be a fund of funds. And what that does is it allows you to aggregate seed capital from the public sector institutions, so the multilateral development banks can put capital and expertise into the program. Governments can put capital and resource into the program. Private sector institutions, that incents private sectors to come in. It has to be pari passu. So for government sectors who maybe are thinking, well, I've got this donor fund that I can put in to seed it, it can't, because now you're making that investment pool strategic, so it's a key point. It has to be financial. So you have to come in on the same level, pari passu. And then what that allows you to do for leveraging is that fund of funds program, let's say government puts in, and I'll show the numbers, but say government puts in $100 million, just for round numbers. That usually will attract some sort of leveraging between 4 to 1. So you attract another $400 million from private sectors. You have a $500 million pool of capital fund of funds. That will invest in private equity fund managers over here. Now, private equity fund managers aren't going to take all their capital from this structure. They're going to probably take 25% of their capital from this structure. And then they'll go out and they'll talk to other institutions and other investors to take the other $75 million that they might raise up in their $100 million fund. So that's another leverage factor by using a tiered structure. So now you've taken that $100 million, it's 500, you've levered it again. Let's say that let's say it's 4 to 1 is kind of a standard. So now you've levered it again. 400 million, so 500 million is now mobilized, $2 billion of total prospective capital. Now those private equity fund managers, they're going to invest in companies and infrastructure projects. If it's an infrastructure project, it's typically going to have debt, sometimes provided by multilateral development banks, sometimes by private sector banks, but it's going to be invested in those developers. Now, they're not going to take 100% of their capital from the private equity fund managers. They might take 50% of their capital or 30% of their equity capital, and then they're going to use debt. And usually debt is leveraged sort of between 3 to 1 and 4 to 1 in some cases. So again, you get another leverage impact. You take that $2 billion and you turn it into $4 or $5 billion of total capital mobilized for low carbon infrastructure, sustainable development. And that's in essence the structure. So now how do you make this investable? That's the leveraging impact, which is key for governments, because value for money is an important consideration for governments. They want to see that if I put $1 in, that I'm going to get $10, $15, or $20 worth of mobilization. But how you make it investable is, and this is where the public-private partnership comes in, is important. You not only make public and private capital partnership, you also make public and private investment fund management. This is a case where you can bring multilateral development banks with all their local resources, expertise, and capability together with the asset managers who bring the financial platform and are recognized as being efficient investors of capital. You marry that together to give a fully supported investment program. You have deal flow, pipeline, technical assistance, but still managed in an efficient and effective way to get your investment returns de-risked into that 8 or 9% return requirement. So that's a key component. It's been one of the bigger challenges when you try to pull together a public-private partnership like this, because as we experienced right off the top, multilateral development banks want to manage this themselves. They just want the private sector to come and deploy their capital, and that's not necessarily always listening or hearing what the private sector institutional investors have to say. At the same time, the asset managers also want to manage this program themselves. They don't always necessarily want to work with a multilateral development bank because they're experts and they don't need to, but that's not listening to the feedback from institutions in the private sector who've said you don't have the capacity, you don't have the track record. You know, you need a multilateral development bank. So some of the other sort of bells and whistles that we build into it, some of the considerations are the large private sector pension funds. They typically will do a certain amount into a fund of funds program, but as well they also like to do direct investments to a fund of funds. Got a couple arrows down the side called co-investments. So that gives the ability for those pension funds to invest directly into projects or directly into specialist private equity fund managers or infrastructure managers operating in developing economies. Technical assistance and risk mitigation. I mentioned earlier that the capital that comes from governments or multilateral development banks cannot be subsidized. If it's subsidized at the point of entry into the fund, banks cannot be. The difficulty with that is it makes the investment non-financial, it makes it strategic. It's subject to policy, perspective, or skew, or at least it's perceived to be. So what we've done is we've designed a program that basically allows the public sector institutions who do have donor funds and the multilateral development organizations who do provide capital on a subsidized basis to come down through a technical assistance and risk mitigation facility, which they already have in place. Again, nothing new. It's all basically in place. And it provides things like loan guarantees on debt finance that's provided by the private sector to get the private sector debt institutions into the investments. And that's the framework, as I said, the key component to get to. I had to give this update at the World Economic Forum in Davos in January. And WEF is a key component to this. They sort of came together with the P8 to set this in motion, if you like. It's a big enough agenda for Davos, big enough agenda for World Economic Forum to bring its counterparties together in and around this. And this itself is a structure that can be taken, as I said, either globally, it can be taken regionally, it can be taken into even municipalities, if you like, in some of the larger economies. And that's a very quick run through 9 months of workup to get through our prototype, which is now going through its scaling process as we speak. So this just sort of demonstrates the leveraging impact that can take effect. It's more important for governments to understand how the leveraging impact takes effect when they put capital at risk. In this example, I've used fairly conservative ratios. You know, it's 100 million from public sector, leverages in 400 million from private sector, brings 500 million of investee funds, which stimulates another 500 million from private equity. I think I mentioned before, that's actually light, but try to be a bit conservative. And then that gets leveraged further in debt finance and project finance in the countries to end up getting to this equation of how do we, in this case it's 100 million gets you 3 billion. The numbers are a bit higher, at least in our informal discussions. And that's a key component at how we get to 100 billion in 2020 of mobilized capital. So with that, I'd like to thank everyone for their time. I'm happy to take any questions, obviously, and I appreciate that we've run over. So.